Hello, my name is Benjamin Hewlett and welcome back to our channel, Death and Taxes. We're talking about the CARES Act, and specifically I'm going to go into more detail about the tax consequences or the tax benefits of the CARES Act. So first of all, one of the interesting things about the CARES Act is that they did a deferral on RMDs. Now this isn't going to affect most of you, but it will affect some of the older generation. Another interesting thing is that there is another retirement tax law, which is that you do not have to pay a 10% penalty on your distribution of a retirement account, which means that I can pull like a 401k, I can pull like some money out of a 401k and not get hit with a 10% penalty. So that's typical of people that are younger than 59 and a half, or people that are 55 that have already left their employer. So basically, prior to that, you would typically get hit with a 10% penalty. So you don't actually have to pay that penalty this year if you get into a situation where you need to pull money out of your 401k. The next thing on the tax side is that you get to take a $300 deduction this year if you make a charitable contribution. Now that is actually brand new this year. So it's a cash contribution and you can take it regardless of whether or not you itemize, which is awesome. So typically you have to itemize in order to be able to take charitable contributions as a deduction. This year, you can take $300 and still take the standard deduction. So that's a new, interesting thing that was in the CARES Act. The next thing is that you can take 100% or up to 100% of your income in charitable deductions. Now, typically in the past, this has been either 60% or 50%, meaning that if I made 100 grand, I could give up to $50,000 in my income. This year, you can give all 100 grand, which obviously doesn't affect most of us, but it does affect some people, especially some of the older generation that I've seen will contribute almost all of their income to a particular charity. So that's an interesting thing for this year. The next tax consequence for this year is that you can actually get a credit for paying payroll tax. Now this affects businesses primarily, but you can, if you keep your employees on payroll, you can actually get a payroll tax credit if you keep them going. So that's a really good one. There's no penalties and interest on the deferral of payroll taxes, which payroll taxes can actually be really steep for businesses. So that's a great addition. There's also some other things that probably won't affect most people. There's some modification to the rules of corporate AMT tax, and there's also a temporary increase to the amount of interest that corporations can take. One of the things that I really liked that affects a lot of my business clients is that they fixed some technical language that a lot of tax preparers were looking for, which is that now you can go back to taking bonus depreciation on a leasehold improvement that before, like in the last couple of years, you've actually had to depreciate over 39 years. So, and you weren't able to take that bonus depreciation. So the 15-year life for leasehold improvements has been reestablished, and it has actually made it retroactive. So we can, if you want to amend your tax return, you can do that. So yeah, that's those are the tax consequences for the CARES Act. Watch our other videos for some of the other consequences, such as student loan and rent deferrals. Please watch other videos. Please give me a like, give me a subscribe. Thank you so much for watching Death and Taxes.
This video has been brought to you by QuickTax Pro. If you want a tax professional like myself to prepare your taxes at a fraction of the cost and time, download QuickTax Pro. See the link in the description below.